Between 50 and 74% of independent coffee shops close within their first 5 years. And the wild part is, almost none of them closed because the coffee was bad. Picture a morning rush. Every seat taken, a line stretching toward the door, the espresso machine going non-stop. It looks like money. It looks like the owner is back there doing really well for themselves. Except the owner usually is the person at the espresso machine, working 70-hour weeks because paying one more barista would eat what little margin is left. Startup years pay the owner little or nothing. Years 3 to 5 might buy a modest salary. Real money usually shows up after year 5, and mostly because a second or third location is doing the heavy lifting. So this video is about the gap between what a coffee shop looks like from the outside and what it actually does to the person who owns it. 99% of small coffee shop closures have nothing to do with the quality of the coffee. The thing that kills these businesses is almost always something the owner walked past 100 times without recognizing it as a threat. And there's one in particular, buried inside the structure of the business itself, that almost nobody talks about until it's already too late. We'll get there. But first, the number that makes this whole thing so confusing. A coffee shop sells one of the highest margin products in food service. The gross margin for most coffee shops runs somewhere around 75 to 80% of sales. That means on a $5 latte, the beans and milk inside it cost less than $1. On paper, that sounds like one of the best businesses a person could possibly open. And yet when you look at what actually lands in the owner's pocket after rent, labor, equipment, utilities, packaging, and card fees are paid, the real average net margin across independent shops is closer to 13.8%, and a small independent café can sit as low as 2.5%, while chains push toward 15%. So on $1 million shop, that's somewhere between $25,000 and $138,000 in actual profit. The number everyone quotes to get excited about the business is not the number that determines whether the business survives. Those are two completely different numbers, and most first-time owners don't realize that until they're already in the lease. Here's what I want to walk through. There are a handful of things about this business that work almost exactly backwards from what people expect. And understanding them before you sign anything is the difference between building something real and spending 2 years funding a very expensive hobby. The last one on this list is the one almost nobody sees coming, and it might be the most important thing in this entire video. Let's start with milk. Most people think of milk as the cheap add-on. The beans are the expensive part, the origin story, the single origin pour-over, the roast profile. Milk is just milk. It's what you pour in after the real work is done. Except that's completely backwards when you look at what actually moves a coffee shop's costs. Starbucks, a company with more purchasing power than most small countries, publicly identified rising dairy prices as the primary negative factor facing its business during one of its strongest sales growth periods in over a decade. They spent $10 to $15 million more on dairy in a single half year than they typically would. And here's the part that matters for any independent owner. Those costs could not be effectively hedged the way coffee or other commodities can. Coffee futures exist. You can lock in a price on green coffee months in advance. Milk doesn't work that way. The ingredient everyone treats as background noise is actually the one with zero price protection, and it moves constantly. Now layer on top of that what happens when coffee prices do move. When headlines say coffee prices crashed, most owners assume their costs are about to drop. But based on industry data from the Specialty Coffee Association and Square's annual coffee report, the reality is that roasted wholesale prices lag the commodity market by months. Your roaster bought green coffee on contracts struck during the prior high price period, and those costs are still working through the supply chain. So a shop can be paying yesterday's high prices while customers assume today's headline drop should already be showing up in their latte. The market and your actual cost structure are running on completely different timelines, and that gap is yours to absorb. So if milk is the unhedgeable cost and coffee is always lagging, what's actually the safest thing to sell? This is where the menu math gets interesting, and it's almost the opposite of what most owners assume. Straight espresso and drip coffee carry the fattest gross margins on the menu. They skip the milk and the syrup entirely. Drip coffee is actually the most profitable item on your menu by a wide margin. The customer who orders a black coffee and leaves in 2 minutes is often more profitable than the elaborate oat milk caramel latte order that everyone assumes is driving the real money. The basic customer is the business model. The elaborate drink is where the margin fight happens, and that fight is getting harder. Oat milk now accounts for 30 to 40% of milk-based orders in urban specialty shops, up from under 10% 5 years ago. Most shops charge a 50 to 75 cent upcharge for alt milk, but on a $6 oat milk latte, that 5 to 6 point margin compression applied to 35% of your drink volume reduces your overall drink margins by 2 to 3 percentage points, which on a $500,000 revenue shop is $10,000 to $15,000 in lost annual profit. That's not a rounding error. That's a barista's salary. Smart menus nudge customers toward the high-margin drinks or price the milk drinks to fully cover what they actually cost. Most menus don't do either, because the owner priced the menu based on what felt competitive with the shop down the street rather than what the math required. Now here's the thing about the math. Even if you nail the menu pricing, there's a cost structure working against you that most people never think about until they're already feeling it. The failure rate for independent coffee shops runs between 50 and 74% over 5 years. And one of the biggest reasons is that the business runs on tiny transaction sizes. A $4.50 latte, a $3.25 drip coffee. That sounds fine until you think about what happens when a customer pays with a card, which almost everyone does now. A flat per transaction card fee eats a much larger share of a $4.50 latte than it does of a $45 dinner check. The math is structurally worse for a coffee shop than for almost any other food business, and it's baked into the low-ticket nature of what you're selling. Packaging costs and card fees are consistently cited as the fastest variable cost levers to pull when a coffee shop misses its revenue forecast, because they hit hardest at the exact price point where coffee lives. And then there's the equipment. The espresso machine is the centerpiece of the whole operation. It's also, before a single shot has been pulled, a debt obligation. Equipment financing for espresso machines commonly runs 12 to 60 months of fixed payments, structured so the payments start immediately, regardless of how the shop is performing. It doesn't matter if you're in your slow month, your first month, or a month where the milk supplier raised prices. That payment is due. It's recurring debt service dressed up as a routine equipment lease, and the terms don't usually look like debt until you're already locked into them and the shop isn't performing the way the projections said it would. Which brings up something most owners don't think about until they're already in the chair. There's a seasonal trap that hits coffee shops at the worst possible time. Most cafes experience a meaningful revenue dip during late summer and early fall, right before the pumpkin spice surge that the industry celebrates every year. So the cash crunch doesn't happen during some vague, slow winter. It happens immediately before the most anticipated sales spike of the year. You have to survive the dip to get to the payoff. And if your equipment payment, your rent, and your dairy costs all hit during that window, that's when owners start making decisions they can't undo. Speaking of rent, this is the one I want you to pay close attention to, because this is the part of the business that most new owners understand the least and that does the most damage. Rent is often the biggest cost, especially in high traffic areas. That's not a surprise. What is a surprise is how many commercial leases are structured in ways that most first-time business owners have never encountered before. And 2 of those structures in particular can quietly reshape the entire business without the owner fully understanding what they agreed to. The first one is called percentage rent. Many commercial leases include a clause where, once your sales cross a certain threshold, the landlord takes a percentage of every additional dollar you earn above that line. Your rent isn't fixed. It scales upward automatically the more successful your shop becomes. So the landlord, who seemed like a passive background figure in year 1, becomes something closer to a silent business partner in year 3, one who shares in your upside without sharing any of your risk. And the threshold that triggers this is often calculated in a way that makes it feel far away when you sign, but much closer when the shop actually starts performing. The second structure almost nobody reads carefully enough is the exclusive use clause. A coffee shop's lease can contain a broad clause prohibiting the landlord from ever leasing adjacent space to any tenant selling baked goods or pastries. That sounds like protection, and it is. One shop sued and won when their landlord tried to lease the unit next door to a high-end bakery because the lease explicitly blocked it. Most landlords don't even realize what they signed away. But here's the flip side. If you're the one who didn't read carefully, you can end up on the wrong side of a clause like that. And then there's the one that connects back to percentage rent in a way almost nobody anticipates. If your lease has a percentage rent clause, it almost always comes bundled with a radius restriction, a clause that legally prevents you from opening a similar business within a certain distance of that location. The landlord is sharing in your profits, so they don't want you opening a competing version of yourself down the street and pulling customers away, which means the lease that lets you open your first shop can legally block you from opening your second one nearby. The agreement that felt like an opportunity on day one becomes a ceiling on your growth by year 3. And by the time most owners realize this, they've already built their customer base, proven the concept, and identified the perfect second location, which they can't use. This is the thing I mentioned at the start. The thing that almost nobody sees coming. Not the beans, not the milk, not the equipment. The lease. A single document, negotiated quickly, often without a commercial real estate attorney, in the excitement of finally finding a space, can determine more about whether the business survives than every other decision combined. One bad clause on page 27 can trigger a lawsuit. 1% rent structure can cap your profitability at exactly the moment the shop starts working. One radius restriction can prevent you from scaling the thing you spent years building. The reasons for failure extend far beyond simply serving good coffee. They encompass everything from inadequate planning and poor location choices to financial mismanagement and lack of brand differentiation. But if you had to pick one document to read 3 times before signing, it's the lease. Not the equipment contract, not the roaster agreement, the lease. So here's where we are. The gross margin is real, 75 to 80% on the drink itself. But the real average net margin across independent shops is closer to 13.8%. with most shops landing somewhere between 10 and 25%. Milk is the one input you can't hedge, and it moves without warning. The commodity price headlines you see don't match your actual costs for months. The drinks with the best margins are the simplest ones, not the elaborate ones. Card fees hit you harder than they hit almost any other food business because of your ticket size. Your equipment is debt before it's an asset. Your slowest cash month hits right before your best sales month. And your lease, if you don't read it carefully, can share your profits, expose you to lawsuits, and block you from growing, all at the same time. None of this means the business doesn't work. The coffee shop industry offers real opportunities for operators who combine passion with smart business practices, and thousands of independent cafes are thriving by implementing proven strategies and building lasting customer loyalty. But the ones that thrive are the ones who understood the actual business before they opened, not the ones who fell in love with the aesthetic and figured out the math later. If you're thinking about opening a shop, or you already own one and some of this landed differently than you expected, drop a comment below. I want to know where you are in the process, what surprised you most, and what you wish someone had told you earlier. The comments on videos like this tend to be genuinely useful for other people going through the same thing, so don't hold back. And if you want to go deeper on the financial side of food businesses, the stuff that doesn't make it into the Instagram version of entrepreneurship, the next video is right there. It's worth watching before you sign anything.